In the last 36 months, the most powerful financial institutions on Earth executed a silent, highly coordinated pivot. They systematically accumulated over 3,000 metric tons of physical gold. This represents the largest sovereign hoarding of precious metals since the Second World War. While retail investors were distracted by endless stock market rallies and the illusion of infinite liquidity, the architects of the global economy were quietly preparing for a paradigm shift. They are preparing for the failure of the sovereign debt system. Welcome to the Shadow Capital Archives. Today, we are deconstructing the quietest, most massive wealth transfer of the decade. We will examine the secretive regulatory trap that weaponized physical gold against paper illusions, fundamentally rewiring the plumbing of global finance. And we will expose the critical difference between the unallocated derivatives of the paper market and the physical reality of what nation-states are actually demanding. Because when the fiat system fractures, paper claims will be the first to burn. For decades, mainstream economists publicly dismissed gold as a barbarous relic, a useless, non-yielding rock. But international banking operates under two sets of rules: the narrative sold to the public and the cold mathematics engineered by the bank for international settlements. Following the 2008 financial crisis, regulators quietly introduced a framework called Basel III. The stated goal was to force banks to hold high-quality, liquid assets. But the hidden mechanism targeted the illusion of the gold market. Under standard capital rules, physical gold locked in a sovereign vault had always been legally recognized as a pristine, Tier 1 asset. But for years, Wall Street preferred the cheap, infinite leverage of unallocated paper contracts. Basel III ended the game. It introduced the net stable funding ratio, a mathematical chokehold that slapped an 85% funding penalty exclusively on unallocated paper gold. Overnight, the cost of maintaining paper illusions skyrocketed. Simultaneously, the framework cemented unencumbered, physical gold as the ultimate zero-risk collateral, equal to cash, equal to U.S. Treasuries. This was not an accident. It was the starting gun. But regulatory shifts alone do not explain the modern panic buying. The true catalyst was the weaponization of the petrodollar framework. When Western powers froze the sovereign reserves of a G20 nation, the fundamental premise of global finance shattered. Foreign nations realize that if they hold their wealth in U.S. Treasury bonds or digital dollars at Western banks, they are subject to extreme counterparty risk. With a single keystroke, billions of dollars of national wealth can be vaporized by foreign politicians. Physical gold, held strictly within your own sovereign borders, possesses zero counterparty risk. It cannot be frozen. It cannot be sanctioned. It cannot be inflated away by a foreign central bank printing endless stimulus. This realization has triggered a modern wave of the Great Repatriation. Nations are no longer just buying gold. They are demanding immediate physical delivery. While historical repatriations took years of careful geopolitical planning, the pace today is frantic. Central banks are quietly chartering private cargo planes, rapidly pulling hundreds of tons of their sovereign wealth out of Western vaults and flying it home. The underlying message is absolute. We no longer trust the financial plumbing of the West. If we do not physically hold it, we do not own it. But there is a critical distinction that retail investors consistently misunderstand: the difference between unallocated paper derivatives and allocated physical bullion. When you track gold on a screen, you aren't seeing physical wealth. You are seeing the COMEX, a digital arena dominated by paper contracts. The overwhelming majority of gold traded daily does not actually exist. It is unallocated paper. Claims upon claims upon claims, backed by a fraction of actual physical metal. This paper market creates infinite artificial supply, mathematically suppressing the true price of the physical asset. Central banks are not buying paper ETFs. They are aggressively draining the physical deliverable supply. They are preparing for a moment of structural deleveraging, a moment when the artificial, fractional reserve paper markets break down, and physical delivery is demanded en masse. When the artificial demand for U.S. debt collapses and trillions of dollars of inflation return to the American homeland, the fiat system will require a profound mathematical reset. Central banks are front-running this inevitability. By hoarding Tier 1 hard assets, they are positioning themselves to revalue gold upward, balancing their disastrously inflated balance sheets overnight. They are protecting themselves from the very economic collapse they engineered.